So controlling the type of income that you're earning, here's the deal. If you don't control the type of income that you earn, you're just essentially paying taxes, and it's going to impact the amount of taxes that you pay. So if you shift your income, let's say towards a passive source of income, right? Because why? Passive income, how many of you guys are aware of this? Passive income sources are taxed at a lower rate than types of income, right? So it gives a good example here. There's earned income. What is earned income? Working a job at McDonald's, all right? And then there's portfolio income. What is portfolio income? Still using the same McDonald's analogy, owning McDonald's stock, right? And then there's passive income. What's passive income? Purchasing a McDonald's franchise. Now, you see, residual income is income that continues to be earned after the initial work has been done. So for example, let's say you're very talented, you're very creative, and you write a book and it becomes a #1 seller, and you sell that book and it earns royalties. The income that you earn from the book is residual income. You don't Hey, we are here every single Monday live, and the topic is money, all right? How many of you guys like that topic? How to make more of it. We see John Mark in the house. Good to see you, brother. How to keep more of it in your pocket, how to save more of it. That's what we're here to talk about every single Monday, and today is no different, all right? So we're excited to have you here. If tonight is your first night, we welcome you. And you're here to come back every single night. You're here to, you can invite a guest, right? You can invite your friends, your family members, your co-workers. You can invite everyone to be with you on our Money Mondays. So I am super fired up. I'm excited to be here with you. Let's talk a little bit about what's happening in the economy. We talk about layoffs, debts, taxes, inflation, income, these things. Today, I want to talk about what's happening around taxes and income. All right. So let's look at what's going on in Canada. You know, the filing date for income taxes is coming up, right? End of April is the deadline. That's coming up. And I want you to understand that, you know, Canadian taxes are marginal, right? So in 2022, if you earned an income of $50,197, between $50,000 and $100,392, you're going to be taxed at 20.5% federally, all right? That's your federal income. This does not include provincial taxes. We're just talking about federal taxes now. If you earned between $100,000 and $155,000, now your tax rate jumped up to 26%. All right, who's excited to file their taxes? And if your income is between $155,000 and $221, it means now you're at 29% taxes, and anything that you made over $221,000 is going to be taxed at 33%. All right, so you can find that on the Canada.ca website. They have all of the links to that, and they post that every year. So get ready for the tax filings. And why am I telling you that? Because I saw this interesting article that says control the type of income you earn to save tax dollars, right? So controlling the type of income that you're earning, here's the deal. If you don't control the type of income that you earn, you're just essentially paying taxes, and it's going to impact the amount of taxes that you pay. So if you shift your income, let's say towards a passive source of income, right? Because why? Passive income, how many of you guys are aware of this? Passive income sources are taxed at a lower rate than income that's earned at a job, right? It's taxed way differently, and I'll show you that today. So I want you to start to consider some strategies to generate passive income so that you can also reduce your overall tax liability. Now, you know, it's interesting because last year when we went to Las Vegas, every year the company puts on an annual convention, and literally like 20-30,000 people, they show up in the MGM Grand. Sometimes it's 2 arenas, and we will hear and listen to different leaders. But on the way back from Las Vegas to Canada, I was sitting on the airplane beside a guy. His name was John. And, you know, it's a couple-hour plane ride. And what do? You talk to the person beside you. I make it a habit to talk to the person beside me on the plane. And found out he was a hardworking guy. He basically lived in a small town in Calgary. And he worked tirelessly as a construction worker. You know, he was putting in long hours every single day, just trying to provide for his family. But, you know, despite John working hard, he was never able to make his end meet, right? No matter what, he couldn't make ends meet. He was living paycheck to paycheck. He was struggling, and he struggled to save any money for the future. And one day he came across that concept of passive income. All right. And that's how he got introduced into our firm. He learned that it was a possibility to earn money without having to trade time for money. This is a big, big mystery for a lot of people, earning money without trading the time. You see, when we grew up with the learning that in order to make money, you need to trade time. So he was very skeptical, but the idea of financial freedom was what intrigued him. Although he was skeptical, hear me out, the idea of financial freedom is what intrigued him. So John decided to take a chance, and he became an entrepreneur in the financial services industry. He put in the effort. He got his license. He studied like crazy. He got his license, and he started to build a business. And at first, the business was a little bit nerve-wracking. He was nervous, right? He was nervous. First time that he was in financial services, first time that he was entrepreneur. All he knew how to do was use his hands. And he was actually worried that maybe he made a mistake. But as time went on, he began to see a steady stream of passive income coming in from his business. And John was thrilled with this newfound financial stability, if you will. He was actually able to quit his job as a construction worker and spend more time with his family. And what he did was he used this passive income to travel the world, help others out in the community, and he finally achieved financial freedom, what he always dreamed of. And years passed, he was able to use that money that he made in the financial services industry and start to make other types of investments. And that's how he was able to continue to build his passive income stream. And he actually became a respected member in his community. He was proud of the life that he built, proud of the fact that he was able to build financial security, proud that he was able to provide for his family. But John is an example of the power of passive income, right? He went from living paycheck to paycheck to financial freedom and security. And he did it all by taking a chance on an idea that he believed in. He got the knowledge and he applied it. See, most people never take a chance. They ask questions like, you know, what are the different types of income? Because they didn't know that there are different types of income. What are the possible ways to earn this income? So I'm going to show you several types, several different streams of income. And I want you to note that some of these might have some overlaps. So let's jump into it. You know, I saw this nice slide here on the internet. I thought I'd use it. It says what? Types of income, right? So it gives a good example here. There's earned income. What is earned income? Working a job at McDonald's, all right? And then there's portfolio income. What is portfolio income? Still using the same McDonald's analogy, owning McDonald's stock, right? And then there's passive income. What's passive income? Purchasing a McDonald's franchise. Now, I didn't have the kind of money to purchase a McDonald's franchise because you need to have $1 million in your account and then you actually purchase the McDonald's for another $1 million, that's $2 million, right? So that was out of my price range. Here's another example. Earned income, working a job at KFC, right? Portfolio income, owning KFC stocks, passive income, owning a KFC franchise. You get the concept, right? Now, earned income, that is what you earn through performing a service or working for an employer, right? So this would be working wages. You're paid an hourly or salaried as an employee, okay? Or it could be salaries earned in professions. Could be a doctor, could be a lawyer, could be a manager, all right? It could even be tips, right? You're earning tips working at a bar or as a hairdresser, and you're working for tips. Earned income is earned using the name. You have to be there in order to earn it. Why am I showing you this? Now, I want to show you some tax implications when it comes to earned income. So let's say that you live in Ontario and you work as a manager, for example, right? And you're living in Ontario, you're making $80,000 a year, all right? You're going to be taxed $20,414 on that money, all right? That means your net pay is going to be $59,586, or call it $4,965 a month. Now, your average tax rate, that's what you're taxed at, is 25.52. So you're taxed essentially quarter of your money, right? Now, that's provincial and tax combined, right? Your marginal tax rate, what is marginal tax rate? Marginal tax rate is if you earn $1 more, this is what you're going to be taxed at. So in this case, let's say that, it's showing your marginal tax rate is 29.65. Let's round it up to 30%. Okay. It means if you earn another $100, you're going to be taxed $30 on that $100. It means your net pay is going to be $70 on the next $100. You know, many people, they put up their hands to do more overtime without understanding the implication of the taxes when it comes to employment or earned income, right? So, by the way, would you believe me if I told you this individual is working January, February, and March, and a couple of days in April for the government? Would you believe me if I told you that? How many of you guys believe me if I told you that? They're working 3 months and some change for the government, right? Let me make my case to you. You're saying, what? Seriously, they're working 3 months for the government? Yep, absolutely, right? Look at this. They paid $20,414 in taxes, right? If you divide their annual income, which is $80,000, divide that by 12, they would basically have a net payment of $6,667. So let's assume that this scenario was this. They needed to pay the government the money first in taxes, and then they can start getting paid. What if this system was where you have to pay the government first, so not at the same time, but all of your money goes to the government, and once you've paid all your taxes, then you could then take some money for yourself and don't pay any taxes for the rest of the year? How many of you guys would sign up for that deal? Most people won't, because here's the reality. Most people don't even understand how much of their money goes the first 3 months. So look at this. January, they pay $6,667 in taxes. All of it. Boom. Let's say all of it goes, right? February, they do the same thing. $6,667 goes. March, boom, another $6,667. All of that would pay off. And plus, they still have to work a couple of days in April to bring it to $20,414, right? So the first 3 months went to whom? The government. This is how earned income works. And by the way, if you're working in a job, I challenge you to calculate how much money is going to the government, meaning how much time out of the year are you working for the government before you see a penny, right? Do you think any human being would work like this if it was positioned like this? If the government said, no, we want our money first? Why do they put it the other way? Because it's less painful. This is very painful to look at this. He said, oh my goodness, 3 months, like a quarter of the year. Yeah, a quarter of the year goes to the government, right? It's just math. It's just math. But many people don't look at it this way. They wouldn't work 3 months for free. How many of you, type it in the chat, would work 3 months free? How many of you would do it? I don't see the chat box lighting up, so I'm guessing nobody is going to do it, right? I'm guessing nobody's going to do it. But the challenge is the majority of people are actually doing. They're actually doing. It's just leveled out sideways, right? It's just leveled out sideways, so we don't feel it. We don't feel it that way. But in essence, that's what's happening. Now, so we have portfolio income. What's portfolio income? Portfolio income is you decide that you want to get into the market, right? You want to earn money from stocks, let's say, or real estate, right? You want to buy Tesla stock. The stock goes up, it pays, and you sell it, right? You're going to make money from the capital gains, right? Or you sell the stock, you make that money. You sell your real estate, you make the money, right? This is called portfolio income. Passive income. What is passive income? Now, people have different ideas of passive income. I'm going to give you my definition, right? Passive income can be things like dividend income. All right. Dividend income from stocks or mutual funds. Passive income could be the rental income that you're getting from the real estate. Now, remember, I said the portfolio income is from the sale of it, right? From the sale of the real estate or from the sale of the stocks. Your passive income is the dividend from the stocks, or it's the rent from the real estate, or it's the interest income from savings or checkings account. I'm trying to say that with a straight face because most banks don't give anything reasonable for any type of interest income. Royalties from books. If you write a book or write music or you have a patent, this will give you royalty, right? Business income, which I'm a big fan of, right? Business income. You get the passive income from the ownership of the company, right? If you're a passive owner in the company. Affiliate or marketing income. Sometimes people do online marketing and all this kind of stuff, right? YouTube and YouTube channels through advertising. All these things can fall under passive income. All right. Now, I want you to remember dividends was one of the segments underneath passive income. How do dividends get taxed? So if you're living in Ontario, all right, and you make $80,000 a year in dividend income, you're going to be taxed around $2,400, $2,430. That means, and this is, by the way, is from a calculator called Wealth Simple. Maybe I'll drop it in the chat box for you. How would you guys like that calculator? It's a pretty neat calculator that you can play around with. Let me drop the link in the in the chat box for you. But yeah, if you're working in Ontario and you're making $80,000 a year as dividend income, how are you going to be taxed? You're going to be taxed at 3.04%. Okay, 3.04%. That's you're going to be your average tax rate. Big difference. That means your net pay is going to be $77,570. Do you remember the net pay from the previous one? Let's go back. Net pay would be $59,000, right? $59,000 versus $77,000. Huge difference. Huge difference, right? So your average tax rate now drops from 25% all the way down to 3%. Right. And if you earn another $100 in not dividend income, but in employment income, look at your marginal tax rate. Look how high it's going to be. That's why I'm saying you need to adjust how you're earning your income. Make sense? I figured the best way to show it to you is put numbers on there, because numbers don't lie, right? Numbers don't lie. Now, what's the difference between passive income and residual income? You're going to hear people use these terms interchangeably. Now, passive income and residual income, they're very similar, okay? In the fact that they're both incomes that's earned without active involvement. So you're not too active in either of them, but there's a very small difference between the two of them. You see, residual income is income that continues to be earned after the initial work has been done. So for example, let's say you're very talented, you're very creative, and you write a book and it becomes a #1 seller, and you sell that book and it earns royalties. The income that you earn from the book is residual income. You don't have to do anything after you wrote that book anymore, right? You don't have to do anything anymore. The book is already written. It's now being sold, right? Passive income, on the other hand, is income that is earned with minimal effort or involvement on an ongoing basis. So you still need to put a little bit of effort into passive income. I'll give you an example. Let's say you come across $200,000. You make a down payment, 20% on $1 million home, and you decide you're going to rent it out and collect rent from the tenants. The income that you earn from the rent is considered passive income. All right. So that's the subtle difference between residual income and passive income. Now, so when we look at earned income versus residual income, let's just put them up on the board beside each other. When you look at earned income, I found this courtesy of the internet. It says you work, then you get paid. All right. And then the process stops. So you work, you get paid. When you stop, the payments stop. That's earned income. Residual income, on the other hand, is you work, you get paid, and then the process keeps repeating itself, which allows you to get paid again and again and again and again. Now, earned income, not only do you work and the process stops, you actually get paid, you actually pay more taxes. You get taxed the highest as an employee. The employee pays the most amount of taxes, bar none, right? So why am I telling you this? Because I'm challenging you to change how you earn your income. That's the solution. The solution is to change how you're earning your income. So do some self-reflection here with me. All right. I want you to do some self-reflection here with me for a second. Ask yourself this question. How much of your income is earned income? It means how much of your income is from a full-time job, a part-time job, something where someone pays you for doing work. You earn that income, earned income. How much of your income is earned income? You see, the majority of people, they work full-time jobs. So 100% is going to be what? Earned income. And that's okay to start there, but you don't want to stay there. Make sense? You don't want to stay there for the rest of your life. You don't want to be a cog in someone else's wheel for the rest of your life, right? It's an expression meaning to be, you don't want to be a part of somebody else's system for the rest of your life. At some point, you want to develop your own system. So the next question that I have for you is, okay, you're working a full-time job. That's fine, no problem. How much of your income is going to be passive or residual, right? How much of your income? Is it 5%? You're just starting off, right? You started buying a couple of stocks and it's making some dividend payments, or you're building a business, right? How much of it is passive or residual? Is it 10%? Is it 50%? You don't want it to stay and remain at 0%. You want to increase that, right? I hear it all the time, but Jermaine, it's risky. You know what's also risky? Not doing it. Not doing it is even more risky. It's even more risky. Employment income is very difficult to keep up to what? to what's happening with the inflation. That's why you'll see a post like this, a news article like this. This was 4 days ago. That's from the Globe and Mail that says, control the type of income you earn to save tax dollars. It made the news, right? It made the Globe and Mail. Control. And when I saw that, I'm thinking, we talk about that every single Monday. We're talking about something of the sort. This is nothing new. Control the type of income that you earn so that you can save on tax dollars. It makes good sense to me, but the majority of people won't take that advice. They just won't take that advice. The majority of people will continue going on as they were, right? So let's jump into it.